now, somewhere in Australia, a couple is sitting at their kitchen table staring at a mortgage statement. They've been making repayments for 7 years, faithfully, every fortnight without fail. And the balance on that statement barely looks different from the day they signed the papers. That's not a glitch. That's not bad luck. That's exactly how the system is built to work. The average Australian takes out a 30-year mortgage, and the data tells us most of them will never actually pay it off. Not because they stop trying, not because life falls apart completely, but because the mechanics of how a mortgage works, combined with the decisions most people make along the way, quietly guarantee the bank stays in the relationship far longer than any borrower ever planned. Today we're looking at exactly why this happens, the real numbers behind how your loan works against you from day one, the traps that silently reset your progress, and what the people who actually do pay their mortgage off are doing differently from everyone else. Let's start with the part most people don't fully understand when they sign. When you take out a $600,000 mortgage at 6.2% interest over 30 years, close to the average new loan size in Australia right now, your monthly repayments sit at roughly $3,670 over 30 years. That adds up to $1,300 or $2,200 paid back to the bank on a $600,000 loan. That means you'll pay $721,200 in interest alone, more than the original amount you borrowed. The bank will earn more from your mortgage than your house actually cost you in the first place. But here's the part that really matters. In the very first year of that loan, of every $3,770 repayment you make, roughly $3,100 goes straight to interest. Only around $570 actually reduces your loan balance. At the end of year one, you have paid $44,040. You have reduced your debt by just under $7,000. This is called amortization front-loading, and it is not an accident. Banks collect the bulk of their interest profit in the early years of the loan. They are legally permitted to structure repayments this way, and almost nobody reads the amortization schedule when they sign. By the time you hit year 10, a full decade of faithful repayments, you've handed the bank roughly $440,000, and your loan balance has only dropped to around $520,000. 10 years. $440,000 paid, and you still owe most of what you originally borrowed. That is the foundation of why most Australians never pay off their mortgage, and the next trap makes it significantly worse. The average Australian refinances their home loan every 3 to 4 years. Every time you refinance, the amortization clock resets. You go back to the very start of the cycle, back to paying mostly interest on every repayment, back to barely touching the principal. And here's the thing, refinancing is sold to you as saving money. Better rate, cashback offer, lower repayments. And in the short term, it might reduce what you pay each month. But if you roll that lower repayment into a fresh 30-year term rather than maintaining your existing repayment amount, you've just extended your loan and reset the interest front-loading cycle at exactly the same time. Banks compete aggressively for refinancing business because a new loan from a new borrower is the most profitable kind of loan they can write. You start paying their profit from day one all over again. Refinancing just 3 times across a 30-year mortgage, which is conservative, can quietly add years to your loan term and tens of thousands of dollars in additional interest. Many Australians do it more than that. Every time feels like a smart financial move in the moment. And every time the bank quietly wins. A significant portion of Australian mortgage holders are currently in mortgage stress, spending more than 30% of gross household income just on repayments. When you're in mortgage stress, the first thing that disappears is extra repayments. You drop back to the minimum required, which means maximum interest, which means the loan stretches further toward that 30-year term and sometimes beyond it. The cost of living pressure Australia is experiencing right now is making this dramatically worse. Groceries up, electricity up, insurance premiums up, council rates up. The disposable income that once allowed extra mortgage contributions has been quietly redirected to keeping the household running week to week. And when cash is tight, the mortgage gets the minimum. Every month that happens is a month the bank earns the maximum. There's also a psychological element here that almost nobody talks about. When people feel financially squeezed, they become shorter-term thinkers. The 30-year mortgage feels abstract and distant. This week's bills feel immediate, so they manage the immediate. They pay the minimum, and the long-term cost of that decision compounds silently in the background for years. Here's the trap that barely gets discussed. Australians have collectively built enormous equity in their homes through decades of rising property values. And that equity is accessible through redraw facilities, home equity loans, cash-out refinancing. The money is sitting there and the bank is happy to let you have it, so people use it. Kitchen renovation, new car, the holiday that's been postponed for 3 years, private school fees, a business opportunity. All completely understandable reasons. All funded by drawing equity from the family home. But what does that equity actually represent? It represents years of repayments, years of your money that went toward reducing the principal. The moment you withdraw it, those years of progress disappear. You have borrowed again against the asset you were trying to own outright. And then, the amortization cycle begins again on the new higher balance. This pattern, build equity, withdraw equity, rebuild equity, withdraw equity, is one of the primary reasons Australians reach their late 50s and early 60s still carrying a mortgage they took out in their 30s. The house has gone up in value dramatically. The loan balance has barely moved. The bank has been collecting interest the entire time. This is the part nobody says out loud. Banks do not want you to pay off your mortgage early. A mortgage cleared in 15 years instead of 30 earns the bank roughly half the interest income. A borrower who makes consistent extra repayments, never refinances unnecessarily, and never touches their equity is the bank's least profitable home loan customer. The bank's most profitable customer looks like this. Takes out a 30-year loan, refinances 3 or 4 times chasing better rates, draws on equity twice, once for a renovation, once for something else, makes minimum repayments through periods of financial pressure, and eventually sells the property to fund retirement, at which point the loan is repaid, not because they cleared it, but because the asset was sold. That is the path of least resistance. And most Australians end up on it not through any single catastrophic decision, but through a long series of small, completely understandable choices that compound entirely in the bank's favor. The system isn't broken, it's working exactly as designed. There's one more factor that almost guarantees the mortgage never gets paid off. Most Australians don't stay in the same home for 30 years. They upgrade. They buy the first home. Build some equity. Sell. Buy a bigger home in a better suburb. Take out a new, larger mortgage. Reset the clock entirely. Then do it again. Each upgrade feels like financial progress because the property is worth more. But the loan is also larger. And the 30-year term starts fresh every single time. Australians who upgrade their home twice during their working life, which is common, can spend 50 or 60 years inside a mortgage cycle while technically only ever taking out 30-year loans. Every upgrade is a fresh start for the bank. So who pays off their mortgage? And what do they actually do? The difference almost never comes down to income. There are plenty of high earners carrying a mortgage well into their 60s. The difference comes down entirely to behavior and strategy. People who clear their mortgage early share a few consistent patterns. They make extra repayments from the beginning. Even $200 extra per month on a $600,000 loan at 6.2% shaves years off the loan term and saves tens of thousands in interest over the life of the loan. Small, consistent additional amounts compounding against the principal produce dramatic results. Over time, they use an offset account aggressively. Every dollar sitting in an offset account reduces the balance the bank charges interest on. Your salary sitting in an offset account from payday until bills are due is effectively reducing your interest charge every single day without you doing anything active. They do not refinance unless the numbers genuinely stack up over the full cost of switching. And when they do refinance, they maintain the same repayment amount. They do not drop to the lower minimum just because the rate or the repayment fell slightly. They treat home equity as untouchable except in genuine emergencies. The kitchen renovation waits until they have cash saved for it. The car gets funded separately. The equity stays in the property working silently to reduce the loan balance. And critically, they understand the amortization schedule. They have actually looked at the document. They know how much of each repayment is going to interest versus principal at every stage, And that knowledge makes the extra repayment decision obvious rather than optional. Here is the honest truth about mortgages in Australia. The 30-year mortgage is not a sentence, it's the default, and defaults are designed to be the easiest path, not the best path. The people who pay it off early are not smarter. They are not higher earners. They are not luckier. They simply understood earlier that the loan does not work for them unless they actively make it work for them. Every extra repayment you make in the first 5 years of your loan is worth far more than the same payment made in year 25, because it reduces a balance on which interest is calculated for decades to come. The bank spends billions of dollars each year on marketing, cashback offers, and refinancing campaigns. Not because they want to help you, because every product they sell you resets the most profitable part of the lending cycle. You are not their customer. In the truest sense, you are their income stream. The mortgage does not have to last 30 years, but paying it off in less requires understanding exactly how it works and making deliberate decisions that go against the grain of every default in the system. If this changed how you see your home loan, subscribe to the channel and turn on notifications. Thanks for watching, and I'll see you in the next one.